Hey, what's up, Market Moose? Mike from the Moose on the Loose. I hope you are doing well today. And today we continue our collaboration with Nelson, and we're going to talk about oil and gas stocks today. Quite interesting because I'm from Quebec. Nelson's from Alberta, so we kind of have like even the battle of like two provinces that are known to be like either pro oil or against oil. For my take, before I let you go, Nelson, I find that Quebec is a bit hypocrites on that part. They don't want to have like pipelines going through their province, but they're happily going to take all the checks from Alberta. So just so you know, even though I'm not a big fan of oil and gas stocks, that has nothing to do for the fact that I'm in Quebec. Because actually, I would take the pipeline if you take the money, or you don't take the money and you don't take the pipeline. But you cannot, like, I don't know. For me, it's just not the right way we should do things. So, what about you, Nelson? Growing up like in oil country, how does it feel like?
I First of all, I'm surprised that we're even getting along because in the world of Alberta, Quebec is our natural enemy, and we. I'm not going to say hate the Quebecers because that's a strong word, but there's some disagreements there, and our politicians especially get very very upset. But I think I really like the way you said that, Mike, because I tend to agree with that kind of statement where it's like, hey, you want the wealth that comes from the oil. You have to maybe tolerate a little bit of discomfort for that. And at the end of the day, we have pipelines crossing Alberta. There's all sorts of pipelines, and it's not a big deal. They're not a plight on the environment. They're there, and they're very non-invasive. In fact, I am looking out my window right now, and I have a pipeline, probably the Trans Mountain pipeline, the one of the bigger ones. It's probably about 100 meters away from my house. It's
Wow.
there. There's a walking path on top of it, and I'm in the middle of Edmonton, so that's what it is. And they're not that big of a deal to have around. So hopefully, I answered that in a somewhat democratic way without losing all of my Alberta cred.
And I mean that's totally fair. I mean, you can be like pro pipelines or against pipelines. The fact is we need them. We have to use them. So I mean, unless you're I don't know, literally living in the woods, like fully autonomous and you have like solar panel, you'll probably use anyway those derivatives. So that was just for the introduction. So before we start talking about stocks, just want to lay out for some investors, maybe that like we have like new investors coming up. Oil and gas stocks are not all the same. So you have what we call like the upstream, which is all about exploring, drilling, producing oil and gas. Then we have the midstream, which are known as pipelines. And we have downstream, which are the companies that will refine the product and sell it. Uh, Most companies in Canada, they are all either focus on exploration and production. You will have a lot of pipelines. We're going to talk about them today, obviously. And you have a lot of companies that are vertically integrated, which means that they are exploring, they're drilling, they're producing, they're refining, they have the storage, the pipelines, and they're selling end products as well. And this is like for me probably my favorite type of stocks, but those that drives the most passion about is definitely the exploration and the production part, because of course when you find more oil and gas and then you can produce, well, there's a party that is going on. We do have some equipment companies, and I want to talk about one today later on in the show as well. And just want to highlight the fact that we don't have like in Canada many refiners or like pure refiners and companies that are selling like either gasoline or other products. There was like what was it, like Parkland that is going to be acquired by Sunoco anyway. But besides that, not really pure player. Most of them are vertically integrated. So, want to start with what is your take, Nelson, on the overall industry, or like what do you like, what you don't like about the oil and gas industry?
Sure. I'll talk about what I don't like at first because that list is probably longer than what I I like. And so before I get too into this, I will tease everyone and say that I do own some oil and gas stocks. So don't get too excited when I start talking negative about it. But I do want to focus on the negatives because the negatives are important. So the first thing, there's no moat in oil. When you go to the service station, when you're looking for the oil to make asphalt for your roads, you don't care where it comes from. If I'm buying a coffee, I care where it comes from. Or if I'm buying oil, if I'm buying gas, I don't care where it comes from. Yeah, you might be loyal to one gas station over another, but at the end of the day, you do not care where that gas comes from. As long as it gets your car from point A to point B, you're happy about that. So if there's no
And if you're
moat, that's a
loyal,
bit of a
it's
problem.
all about the points you're getting, right? It's not about like, oh, I prefer that gasoline because I noticed that when I gas at
Exactly.
Esso, my car drives faster.
Yeah, right. Like so it's a commodity product. The second thing is that it's a commodity product prone to wild swings in price. Oil is, Mike, about $65 a barrel right
Hmm.
now. In the last 5 years, it's gone from negative, which we saw in COVID, that made big headlines, to I think more than $100 a barrel in 2022. So imagine you're
120
selling a
actually.
product imagine you're selling a product and you don't know what price you're going to get tomorrow, and it could swing that much in the course of just a matter of a few years or a few months. When times are good, everyone's celebrating and laughing, and when times are bad, it's like, hey, wow, we have to stop producing, things are so bad. So for me, that's not a very good business that I want to invest in. I want a little more stability, I want a little bit more pricing power. And ultimately, as a dividend guy, stability and pricing power translates into higher dividends. And finally, there's exploration risk on the exploration production side, the upstream side you were talking about. When I'm looking for oil, we all have that image of the guy like walking around rural Texas and drilling on a hope and a prayer, and he hits a gusher and it's like, oh yes, baby, yes. But what they don't show is the guy, drilling and hitting nothing, just more dirt. And that's a problem when it comes to oil. And yeah, technology is better. And we know that, for instance, like in Alberta, we know that there are certain areas that are generally quite oil rich, but it still comes down to there's exploration risk, because you still have this risk of being able to find the oil and then be able to take it out of the ground for a certain price that's profitable. And you just combine those things together. And for a lot of the sector, it's a tough place to, one, make money, but two, for this, dividend focused podcast we're doing, is the dividends are just not that sustainable. And that's a problem for people like us who are looking for sustainable dividends.
I totally agree with you on that. I focused on companies which has the ability to increase their dividend every single year. And when I look at most exploring companies in the oil and gas, it doesn't happen. I mean, you're going to have like those crazy dividend increases, like 50%, and then sometimes 100%, and then all of a sudden nothing. I mean, I look at right now the dividend triangle for Peyto Exploration and Development. The ticker is like PEY, and it all looks good if you look between like 2020 and then 2022 or 2023. But what happened before and after that is like flat or dividend cuts. Same thing with revenue and earnings. It goes up, it goes down. It's nothing stable. If I put the dividend triangle for 10 years, well, I realized that right now Peyto is like trading around $18, but it was trading above $30 10 years ago. The dividend is about the same, and it was cut in the meantime several times actually before the COVID. So it was not about a COVID thing. There was like a first cut in 2018 and then another one in 2019. So when you're thinking about the oil and gas, you cannot just play around with the dates, but you need to look at like 10, 15, 20 years as compared to other companies that are actually, yes, they're going to be cyclical. They're going to go through some rough times, but those rough times are not catastrophic. It's not a moment where everything's going to bust and then you're left with almost nothing. And from a dividend growth perspective, it's really bad. So most of the time, what I find around those companies is the narrative is a lot stronger. So the story you tell yourself about the exploration, about the oil and gas, pop him up to like above $100 a barrel. And fun story, I read like research done by economists from banks back in 2010, like 15 years ago when I was a banker. And they were like very convinced that the oil barrel is going to hit $200, which was like, oh, this is going straight there. We don't even talk about that, right? I mean, you just mentioned like the oil barrel is trading around like $65 right now. So we're pretty far away from the $200 that they promised or envisioned. That was like 15 years ago. And that's the biggest problem. When you don't have control over a key element in your business, that's a super weakness. Do you have any good points about oil and gas? They are. And actually, I do have like two companies that I own in my portfolio that are related to this industry. So we're gonna end up with some positive stuff. Don't worry, guys.
Yes, we are. And I'm going to start with the positive stuff right now because we talked about the E&P companies, and those are what I do as an investor. I just avoid those. Like, they're just out of my wheelhouse. They exist, people can talk about them, and I just let them talk. They don't exist to me. So then we come down to, we have integrated oil companies and we have pipelines. And I know, Mike, you
Mm.
want to talk about the pipeline. So I'll talk a little bit about the integrated oil companies because I think that that is a better oil model. So we talk about the integrated companies in Canada. What do you have? You have Imperial Oil. That one owns oil sands assets and then refineries across Canada. There's Suncor, which is the same thing, oil sands assets and then refineries. And then there is Cenovus, which has refineries, which has oil sands assets, and has some conventional oil assets as well. So those ones, when you
Yeah,
control the
CNQ as well.
entire, CNQ does not have any refineries.
Yeah,
They
fair
ship
point.
all
Yeah.
their, but CNQ is another one that there's no exploration risk because that's an oil sands company and they're just exploiting the resource that they have, and then they'll acquire other oil sands companies as well. So you don't have that exploration risk. So that one we can loop in that basket as well. So you got these four companies that, for me, it's like that's the most interesting part of the oil business in Canada, because when you can control the entire process, if you're Suncor, you take your oil, you ship your oil to your refineries, and then you ship the gasoline from your refineries to your gas stations. Suncor owns Petro-Canada gas stations. You When you control the entire process, the price doesn't matter as much because all you're doing is just taking your oil and essentially selling it straight to the consumer. And there's a certain profit in that from that perspective. So it's a little better than the exploration part of it. And that part of the oil business is more attractive to me. And those companies too, as well, they tend to pay much lower dividend payout ratios. So they look at this and they say, hey, we want to keep the capital aside that we need to continue explore and continue increasing production, to keep the refineries going, to build more gas stations, etc. So they're constantly looking at this as, we have this entire business and we want to move forward with this entire business rather than a conventional oil producer, which just wants to drill for oil because that's all they do.
And I want to add something here because even though, and I totally agree with you, Nelson, about the integrated part because it gives them a lot more control. But even then, Synovus and Suncor ended up cutting their dividend. It's kind of crazy. And I remember I was quite surprised because like about 2 days apart or almost on the same day, Suncor announced a dividend cut during the COVID crash, and then Canadian Natural Resources says, "Oh no, we're gonna increase ours. Like we're that strong." And this is one of the reasons why I love so much to focus on companies that pays a dividend because you have an extra set of metrics you can use to analyze stocks. And the difference in the confidence from management from one company to another, that told me a lot about the overall business. Say, well, CNQ either like either they don't know what they're doing completely, because sometimes that's what happens as well. We saw how like BCE kept growing its dividend while it should have like slowed down and then probably cut it 3 years ago instead of waiting to the last minute. So sometimes you have bad management as well. but their premise has always been, well, we're profitable as long as the oil barrel hovers around 35, $40. So whatever happens, we're sitting on those huge reserve and we're just going to pump up more if the price is good, and then we're going to slow down if not. That helps the balance sheet as well. But even then, Suncor and Cenovus had found a way, even though they were vertically integrated, to mess that part up. So it's unfortunate, but just want to highlight that it's far from being perfect in terms
Mhm.
of an industry. On the other side, you have Imperial Oil that is just a stellar company. I mean, the dividend triangle is strong. It kept on increasing. I think they're like what, like close to 30 years now of consecutive dividend increases. It's more than
It'll be
20 from
it'll be 31 years in December.
31 years. That's crazy. And they're not about to slow down this pace. So very, very solid business here. You can definitely sleep well. They're paying a decent yield on top of that. So if you're looking for some income, that could be interesting. And for those who want more yield, I think we can close that show on talking a little bit more about pipelines, where you're going to find the only type of businesses that are not fully related to oil and gas price. One thing though is their stock price will still move according to what's going on in the commodity price. But in reality, they sign like 10, 15, sometimes 25 years long term contract. That's the case for Enbridge and TC Energy, where they're like, Enbridge is like almost half and half now, natural gas and oil. They used to be more oil. They bought more exposure to natural gas. I guess there is a big trend towards NGL right now. TransCanada is mostly it's now just natural gas because they spun off Southbow. And if you look at Southbow and TC Energy, it's kind of interesting because Southbow is not doing that well. Heavy debt probably not going to increase their dividend for a while. So maybe it's going to be stable, but it's going to be very tough because they're capital intensive, and the market was disappointed by the lack of like earnings guidance moving forward, like EBITDA and so on. And I kind of understand because they're going to be, yes, generating a lot of cash flow, but it's going to be like a stable business and it's not going anywhere. Maybe natural gas has a little bit more growth potential moving forward. So those two are very strong player, very safe dividend. I used to own Enbridge. I sold it based on the fact that I prefer companies with a higher dividend growth rate. So when I bought it in 2017, the company was increasing its dividend by 10% per year. So it was a strong grower. I bought it on price weakness, so that was a good fit with my investment thesis. Today, I don't regret selling it. I actually sold it right before the stock price dropped. Now it's going back full strength. And I'm like just happy for investors, but I did not want to have kind of like a bond proxy, which I called it the deluxe bond in my portfolio. I rather have like company with more growth. I mean, if you're excited, once again, the same story. If you're excited about the recent stock price jump over the past year and a half for those pipelines, if you look at the graph over the past 10 years, it's kind of like the same story over and over and over and over again. So yes, it's great, but don't expect this trend to be like something that is going to be continuous for the next 7 years. So I don't know what your take about those pipelines. Do you own any pipelines, Nelson?
I own Enbridge and I own TC Energy, and I got the Southbow shares from that spinoff as well. Just a quick word on Southbow. It seems to me like TC took a lot of their as much debt as they could and just sort of put it onto Southbow, which made Southbow a little weaker, but did strengthen TC as it
Yeah.
as well. But for me, ultimately, I view pipelines as sort of utilities, but with a little
Hmm.
bit more risk. Because Mike, you're right. Like they will go up and down depending on what oil is doing. But you talked about Enbridge, TC Energy. They've both been strong lately, even though the price of oil has been weaker. So it's not a perfect relationship, but it's definitely one that exists and that you should be at least aware about if you're an investor in these companies. But again, like I said, for me, ultimately, these are utilities, and what both Enbridge and TC have done is diversified a little bit more into the utility business. So Enbridge is the natural gas utility in Ontario. They bought another natural gas utility in Utah, which I think is a really nice business for them. They transport the natural gas anyway, so they can just divert some of the bit over to their utility. They've got the infrastructure in place. that's a good thing for them. And of course, TC Energy owns a portion of Bruce Power in Ontario, which is the nuclear plants there, which I'm a big nuclear bull over the long term. So I like that exposure as well. So I think these companies too have sort of realized that, okay, the long-term growth in oil and gas might be a little bit more limited as our consumption of that slowly goes down. So let's pivot a little bit more into the utility business. I like that pivot over the long term. And one more thing I will add very quickly is the growth of natural gas fired power in the United States. So in
Mhm.
Canada, we really don't have a lot of coal fired power left. I think there's a couple in Saskatchewan and that's it. But in the United States, there are quite a few coal powered power plants out there that are slowly converting to natural gas, which will need natural gas pipelines. And both Enbridge and TC Energy are in a good spot to go to these power plants and say, hey, we'll build the pipeline for you and enter into those long term contracts that you talked about. So it's just more of a, yes, it's not really a utility, doesn't technically make them a utility, but it's just more into that direction, which I like over time.
Yeah, yeah. The business model is very similar to that utility business, and actually some investors sometimes will confuse the pipelines and will say, well, is it not like a utility business? And even if you look at Brookfield Infrastructure, which is a utility play, well, they have like about 30% of their business is actually pipelines that they bought. So
Mhm.
sometimes it's very similar business model, a lot more stable. And of course, I mean, the proof of longevity of the dividend growth for both companies prove that as well. Want to end up with a very interesting business. And I don't know if you have looked at this one, but I bought Terravest Industries, I think about year and a half ago. It came out on my radar because like the company started to fly high in terms of like revenue exploding, earnings per share exploding, and of course the dividend exploding. So for me, it was like, wow, perfect dividend triangle. Of course, it's a small capitalization, so expect a lot of volatility. And it's not, I mean, recently dropped. So not the first time that it goes up and goes down. So just be careful about that. I treat it as a speculative play in my portfolio. But I was quite surprised about their business model and the fact that it's like highly fragmented. So what they do is that they specialize in equipment. Most of it is like storage tank for all kind of like sizes. They also manufacture home heating products that is all related to natural gas liquids. And they're buying a lot of smaller competitors, integrating them, and they're doing a good job out of that. And one thing I like as well for the long run is they are increasing their maintenance services. So it's one thing to sell the tank, but after that, once you have your tank, you have to take care of it. So they're just like, yeah, we're going to take care of that part too. So they sign contract. That's recurring revenue, a lot better than just selling like storage tanks everywhere and eating products. And I think it's going to be a good move for the future. So I don't know if you have looked at this one, Nelson, but maybe we can end the show on this one.
This is one that I haven't looked at super closely, so I will cede to your expertise on it. I'll just say that what I've seen, you're right. The growth by acquisition model looks very attractive for these guys, and the growth has just been stunning. Ultimately, with stocks like this one, it comes down to their ability to acquire more and more over time. It looks like Terravest has this kind of secret sauce that they've been successful at it. At least the last couple of years, they've been very successful at it. It's just over time, I'm always a little bit skeptical that they can continue to find acquisitions at good prices. I know Exchange Income Corp, which is a little bit of the same model. They're not
Yeah.
into the oil and gas, but for a while there, their stock was struggling because they had a little bit too much debt and they couldn't really find things to afford or to acquire, and then the dividend might have been a little bit high for a company with that much debt. Different model, but the point is that it's sometimes good to be a little bit skeptical of the ability to acquire over the long term. But saying that, if you look at it as a mini Constellation Software, which I know the Bulls do look at it that way,
Yeah.
that's a company that has had a lot of success acquiring for a long time. So it's definitely achievable. It's just for me, I threw it on my too hard pile because I'm just not that confident in their ability to keep acquiring.
And that's totally fair. I mean, just for the record, the average PE ratio over the past 5 years at 18, which seems pretty solid. The forward PE ratio for this year is at 32. So we see a big case of yes, it's growing fast, but there's also a lot of PE expansion, meaning investors are expecting a lot from this company. And if it doesn't deliver, well, you're in for a rough ride. So this one definitely not financial advice. You really have to understand in which kind of boat you are putting your foot into if you're getting for this one. But I thought of like ending the show with an exciting note. So if you want to look at this one, I think it's going to be great. So Nelson from Canadian Dividend Investing, do not forget to look at his newsletter at Canadian Dividend Investing. Is it .com or .ca? Can remember.
.com.
.com, of course. That's good. All right, Moose, that's enough for today. That was a great episode. Do not forget that we have a free webinar on how to analyze quarterly earnings and make sense of those price going up and going down on September 18th. You can register for free at moosemarkets.com/webinar. And until tomorrow morning, don't forget to stay invested.